So returning to the material now and going back to the income tax computation itself, we've looked at a couple of examples where all of the income has fallen in the other income category. We're now going to introduce some questions that look at savings and dividends. The important thing to remember when dealing with different types of income is this succession from other to savings to dividends. So the personal allowance and the reliefs are always applied to other income first, then to savings and then to dividends. Equally, we tax in that order as well. Other income first, then savings, then dividends. We work our way up through the bands as we go up through the income, and we do not go back to the basic rate band when we move on to the next type of income. We always start from where we left off. We're going to see how this works in example 3. So in this question, she has the following income and outgoings. She has trading income, which again is other income, employment income, which is also other income, bank interest, which is savings income, and we need to gross it up by 100 over 80 because it's bank interest. And dividend income, obviously dividends, and again that needs grossing up by 100 over 90 because dividend income always requires that. We then have a qualifying interest payment, so that is a relief that will need deducting from our total income. We're told that she's paid PAYE, and that will be important because we're asked to calculate the income tax payable. So to set out the answer to this question, we're going to need columns for each type of income. Dividend income on the far right, savings income before that, other income before that, and a total income column. Always make sure you've got enough room for all the columns that you require. So her first type of income was trading income. That was £11,615 straight from the question. And that goes in both the total and the other income columns. The total income column should always include everything, and then the individual columns for the types of income just take the relevant parts of that income. We then have employment income. Now the question did state that the employment income figure was gross. In actual fact, employment income is always provided gross. And the easiest way to remember that is to remember that if someone asked you what you earn, you would give them your gross salary as an answer, if you were prepared to answer the question. You would not tell them the amount that you actually receive after tax has been deducted. On the other hand, if you were asked how much you get in your bank account in terms of bank interest, you'd look at your statement and see the net figure, and that is the figure you would provide. So that's how I remember which ones are usually provided gross and which are net. So the bank interest needs grossing up. It was £2,800 and it needs grossing up by 100 over 80. So the gross figure is £3,500, and that goes in the total and the savings income columns. We then have dividend income. The amount received per the question was £1,800, and that needs grossing up by 100 over 90. And so the gross figure there is 2,000, and that goes in the dividend income column. So the total income is £30,115, of which 24,615 is other, 3.5 is savings, and 2,000 is dividends. We then deduct any reliefs, and we do have a relief in this question, which was the qualifying interest payment. So that was £1,000, and that can be deducted from the total column, and as always we deduct it from the other income column first. So that means that the savings and the dividend income is not reduced. If we didn't have sufficient other income to absorb this £1,000 deduction, we would then move on to savings and finally dividends. Net income, therefore, is 29,115, of which 23,615 is other, 3.5 savings, and 2,000 dividends. We then deduct the personal allowance, which in this question is available in full because she is not a higher income individual. We deduct the personal allowance, like the relief, from other income, which is still sufficient to absorb it. We are now down to her taxable income, which is £18,515, of which £13,015 is other income. 3.5 is savings and 2,000 dividends. We can now calculate her income tax, and we tax other income first, and we start in the basic rate band. Now, in actual fact, we can stop at this point and have a little think about the level of her taxable income. It is less than £32,010, and therefore she is only going to be a basic rate taxpayer. We can clearly see that we're never going to have to do any tax at the higher rate. So we can tax all of her other income at the basic rate, which is 20% for other income, and that is income tax of £2,603. We then move on to tax savings income. Now, we do need to check that none of the savings income falls in the starting rate band, but the starting rate band of 0% for savings income will only apply if savings income falls within the first £5,000 of taxable income. Since we've already taxed more than that amount with other income, we will not get any starting rate tax. So the savings will also be taxed at the basic rate. So £3,500 of income. The basic rate for savings is also 20%, and that is £700. Finally, we move on to dividend income, and we're still in the basic rate because she doesn't actually reach the higher rate with her income. And therefore £2,000 is taxed at the basic rate for dividends, which is 10%. So that's £200 of tax. That gives us an income tax liability, and that is £3,503. But we're not finished yet because the question asked for income tax payable. So we need to deduct the tax suffered at source. We will always deduct the tax credit on dividends first. That is the gross amount, which was £2,000, at 10%. That's the same as the difference between what was provided in the question, £1,800, and the gross amount we've taxed, £2,000. So the dividend tax credit is £200. You can see that that nice and neatly cancels out the £200 of tax we've actually suffered. And that will always happen if an individual is a basic rate taxpayer. The reason we must deduct the dividend credit first is because if the dividend credit exceeds the income tax liability, you can only reduce your income tax liability to nil. You cannot make a repayment of income tax. That's because the dividend tax credit is not real tax paid. A company doesn't deduct 10% tax before they pay a dividend, whereas banks and building societies do deduct 20% and pay it over to HMRC. So the dividend tax credit is sometimes referred to as notional. It does reduce your income tax liability, but it cannot create a repayment. We then move on to the other credits, and the order they go in, it doesn't matter. So we can deduct the PAYE of £480, which was given in the question. So we have a tax credit on the savings income, which is the gross amount of £3,500 at 20%, and that is £700. And again, this always works for a basic rate taxpayer. That cancels out the income tax liability on the savings income. So the income tax payable is £2,123, and that will be due via the self-assessment system.